All right, well, we're going to go ahead and get started. And welcome to the Financial Accounting Review for Test 1. And we're going to start out with this first problem. As you can see, we're going to prepare some financial statements. We're going to prepare an income statement, a statement of retained earnings for the year ending, and we're going to do a classified balance sheet afterward. So who can tell me, first of all, let's identify the accounts that goes into the income statement. And let's identify all these accounts before we get started on any of this statement. I want you to tell me each of these accounts, what category would they fit in? Like wages and salaries payable. Would that be an asset, liability? That'll be a liability. How about wages, salaries and wages expense? Just like that. It's going to be an expense account. Of course, you got utility expense, so it's going to be an expense account too. How about equipment? That'll be an asset. Absolutely. How about accounts payable? Be a liability. What about service revenue? It's not a liability. It is what it says. It's a revenue. Of course, we know what that's going to be, right? That's going to be a revenue. How about that? How about notes payable? That's going to be a liability. And with this one, why do you think they put dates by the notes payable? To let you know whether it's long-term or short-term, because depending on whether it's long-term or short-term, it goes in the balance sheet in a certain section. Well, this is the line drawn between that. Short-term is anything that's due 12 months or less, or a year or less. Anything greater than a year is going to be considered to be long-term. How about common stock? How about cash? That's going to be what? That's going to be an asset. Accounts receivable? That's going to be an asset. Dividends is going to be dividends. Yeah, and I'll show you where that goes into the financial statement. You won't see it in the balance sheet, but I'll show you where that goes. And we know what this is, right? And we know retained earnings, where retained earnings go. And that's going to be a stockholder's equity too. Now, you notice they use the term right here, beginning of the year. That means something, because that's what you're going to use to start the retained earnings part of it. So now that you've identified these, let's go back and see. So if it's a liability, where should it go in terms of the three statements that we taught? If it's a liability account, it should go on the balance sheet. So if it's an asset, where should it go? Balance sheet. Absolutely. How about an expense? Goes in the income statement. Revenue goes in the income statement. Absolutely. So now only one that you might not be totally familiar with was that dividends. And that dividends goes in the retained earnings statement. Basically, you can decide that in the wording of the transaction, because the wording in the transaction would kind of show whether it's going to be an expense or a revenue. But 9 times out of 10, it's going to say, in this case, what it is. But in the wording of the transaction, it's going to tell you, I perform this and incurred this kind of expense. It'll tell you in the transaction. As you become familiar with reading transactions, you'll be able to identify it instantly. It comes with practice. Yeah. So let's see. I'm going to give you a moment or so to see to do the income statement. Go ahead and see if you can do the income statement right quick, and then we'll go over it. And as you do that, the reason why they have you doing the income statement, because the income statement is always prepared what? First. Then the next one you prepare in order will be the retained earnings. And of course the last one in order is the balance sheet. That's what your income statement. You got service revenue. You identify that. Equipment is an asset. When you purchase equipment, it's considered a resource for the company, and it becomes an asset because you're going to use it over a period of time to produce stuff for the company. So it's considered an asset, and where we say asset goes on the balance sheet. Yeah. So you got service revenue, which was $72,100. Then you got rent revenue at $8,500. To give us a total revenues, because we're going to add these up, right? Total revenues of $80,600. And then we got the expenses that we identified. Salary and wage expense came in at $50,700. Utilities, $22,600, and then we had rent expense at $4,000. Give us a total of $77,300 in expense. As you notice, and I think your Connect may do this to you. As you notice, see these your expense items, They're in order by what amounts are they? You see that 50,000 there, and then it goes down to the 22, and then it goes down to the 4. So you add those up, and then you give the total expenses overhead, 77,300. Now, how do we get our net income or loss? Which in this case, it says loss, but that's wrong, right? We know that's wrong, right? This actually is a net income, How do we know it's a net income? So we know it's a net income because we looked at what? We looked at the revenues compared to our expenses. That gives us a net income. Now, had our expenses been greater than the revenue, then it would have been a net loss. So let's go ahead and try the retained earnings statement. Now remember what I told you about retained earnings statement. You're gonna have to start out with this number to give you a hint, right? You got to start out with that number there. So you have to start out with that number. Let's go back up to it. See that where it says beginning retained earnings? You got to start out with that beginning retained earnings. So now, remember what we talked about. We talked about these statements being in order. The income statement first, retained earnings, then balance sheet. Now, it's a reason for that is because once we're done with the income statement, we have to take a number off this income statement, which is income. We have to take it where? We got to take it to the retained earnings. So you're going to need that to go to the retained earnings. Done with that, let's take a look at what it looks like. There's your retained earnings. Retained earnings statement for the year ending. We started out with the 42,200. Remember, that's the beginning. That's the beginning. Then we had to bring in the net income of 3,300 as an addition. And because we paid out some dividends and we got that from up top, right there, as your dividend amount, 2,000. We have to subtract the dividends out of there to bring over here. This is called, this amount over here, this 1,300 is called a net increase because it's positive. So that's a net increase in your retained earnings. So you add that to the beginning, you come up with a new balance, which is the ending retained earnings of 43,500. Look at the flow. When you look at these statements, look at the flow. It's flowing from the income statement, taking the net income, you're bringing it down to the retained earnings. You're going to add it. Then you got to subtract out the dividends, which is going to give you a net increase of 1,300. So we got an ending, they call this an ending retained earnings of 43,500. That's your ending retained earnings. So be careful on your exam to know the difference between your beginning and your ending retained earnings. Because guess what? The next step is we have to do the balance sheet. So to do the balance sheet, we're going to need something from the retained earnings statement. What are we going to need? We're going to need the ending retained earnings, exactly, to finish off the balance sheet. And we know what goes into the balance sheet, and let's go back up. You told me earlier that assets, liabilities, and equity, stockholders' equity accounts go into the balance sheet. Now, only thing you have to remember is, like you said, that ending retained earnings got to go in there too. So we started out with that income statement, then we pulled down the information we needed to complete that retained earnings statement. Now we're going to take this ending retained earnings and we're going to take it to the balance sheet. So I'll give you a moment to work on that balance sheet and then we'll go over it. Your proper headings for the income statement is for the year ending. For the retained earnings, it says for the year ending. It's going to be a little different for the balance sheet, and we'll see that when we get to it. It's going to be a little different for the balance sheet. So let's take a look at the first part of the balance sheet. You see the first part of the balance, it says here, balance sheet, and then it just has a as of date. They call that an as of date of July 2016. And the reason the income statement and the retained earnings statement is worded that way because we're looking at these statements in a period of time. It's usually a 12-month period. So it's going to say for the year ending July 31st, 2016. It's a 12-month period. Your balance sheet is continuous. The accounts are updated and they keep flowing through from year to year, from year to year. So the balance is a continuous balance that's being adjusted. First thing we put in the balance sheet, we put our current assets. When we looked up there, we got current assets. Cash is a current asset, 30,200. Accounts receivable, it's a current asset at 12,780. And then over here, what we do is we add those up to come up with that 42,980. Total current assets. Y'all see that? You add that up and then bring it over here for the total current assets. Once you got your total current assets, you're going to go to the equipment, which is a I don't know if you got into this or not. It's a non-current asset. Equipment is a non-current asset. And you will know, you got those accounts, you got to learn those. And you'll know it's going to be cash, it's going to be accounts receivable, it's going to be prepaid insurance, it's going to be inventory. Those are going to be your current assets. You'll know equipment, and the other part of the assets it'll say long-term. It'll say long-term assets or non-current assets. Yeah, but equipment, they call them equipment, is beyond the property, plant, and equipment. It's going to always be non-current. But of course, your current assets always come first, and you got equipment of $15,000. So you're going to add both of those together to get your total assets of $57,980. So you're going to add them together to get total assets. So in the balance sheet, you learned something early on in chapter. I guess this is in chapter 1. You learned an accounting equation, didn't you? How does that accounting equation read to you? Somebody tell me. Assets equal liabilities plus stockholders' equity. That's what this balance sheet is. That's what this balance sheet is going to do. So you already know that your liabilities and your stockholders' equity has to equal your total assets. That's your way of checking whether or not you did it wrong or right. If they don't equal the total assets, then something went wrong. So we're going to go down and get the liabilities from up top. The current liabilities, as you see, $4,100. That's the accounts payable. And remember, we had salaries, wages payable at $2,580. We added those up to give us a total current liabilities of $6,680. Total current liabilities. Then y'all remember we had this non-current item here, or long-term notes payable. So we're going to add that in with the current liability, which is going to give us a total liabilities when we add these two of $8,480. Y'all see that? So that's our total liabilities now, the $8,480. That's your total current, and then of course that notes payable. That's considered a non-current or long-term. Then we go back, we had common stock up here. I'm gonna go back up here just so you can see it again. You had common stock right there. We picked that up and brought it back down right there in our stockholders equity section. So now we got the total liabilities. Now we go and created stockholders equity. We got common stock at $6,000. And then remember the retained earnings. This is the kicker. This is where you don't want to get lost at. Is when you get that retained earnings, remember you got to get the ending retained earnings from the retained earnings statement. Don't get confused and get that beginning amount. Remember we hit that beginning amount, which was 42? Don't get confused. Get the ending amount to go in there. Make sure it's the ending amount. So now I got my $6,000. I got my $43,500. I add those together to get my total stockholders equity of $49,500. Now, I just told you with the accounting equation, assets has to equal liabilities plus stockholders equity. So I'm gonna add my stockholders equity to my total liabilities right there. I'm gonna add those two together, this one and this one. And look what it does. It comes out to that $50,980. So we know we're okay. We know we were in balance. Right? We know we're in balance because that number here, total liabilities plus stockholder, this number right here equals the total asset number. That's how you know you're okay. You're in balance. If that was off, we'll have to go back and recheck some things and see why that's off. In accounting, once you see it in the balance sheet, people that kind of read the financial statements, or they already know that should be the ending. You know. Now they'll do it in a trial balance, because the trial balance, y'all talked about trial balances yet? Trial balance would just sometimes have the beginning in there. And then you have to work your way like we just did to figure out what the ending is. But once you come into a finished balance sheet, it's assuming that's the ending retained earnings. So now, we've got that. We've done let's go back through this flow again. So you see this flow. We went to the income statement. What goes in the income statement? You guys told me it was liabilities. I'm not liabilities. It was revenue and expenses, right? You subtracted the expenses from the revenue. You got net income. We took that net income and we brought it down to your retained earnings statement. We went up and got the dividends and subtracted the dividends out and created a new retained earnings balance of $43,500. We then went to the next statement, which is a balance sheet. We took that ending balance, and once we put in our asset, our liabilities, and our equity, and we added that $43,500 in the equity to give us $49,500, we can add them together, and now we got total liabilities and stockholders equity, which is going to equal your total assets. Now we're in balance. So That's the financial statement. Now what we're going to do is we're going to do some transactions. And let me tell you, here's the transactions here. And it says journalize the following business transactions in the journal form. But let me remind you, and sometimes you may not be putting this connection together. How you get the numbers that we just worked with, you get them through these transactions. If you don't do these transactions, you can't get the numbers that we just worked with. So I know we're doing it sort of in reverse, but this is what comes first, is these transactions. So I'm gonna give you a moment to maybe run through a couple of these, and then we'll run through them. And when they're talking about journalizing, we're talking about a debit and a credit, right? Because we know each transaction, you have to have a debit and a credit. If you got two debits and you have no credits, it's not right. You have to have a debit and a credit. And in doing these journal entries, you have to know how to increase and decrease accounts. And we know what accounts are. That's cash, accounts receivable, those expense accounts that we just talked about. You have to know how to increase or decrease and what their normal balances are. So I'm gonna give you an example. How do you increase a cash account? With a debit or credit? With a debit, because we know it's an asset, right? This is the difference. When it's on credit, how you know whether it's notes payable or accounts payable is if it's notes payable, it's going to tell you it's a note. If it doesn't say it's a note, it's automatic, it's going to be accounts payable. So if it doesn't say a note, it's going to be accounts payable. So you have to know how to increase. So if it's a liability, how to increase a liability, debit or credit? Credit. And you got, be careful on number 3, because you got 3 accounts going in there on that number 3 instead of just 2. So how do you increase a revenue account? Debit or credit? Revenue account. Always credit. Yep. And you're gonna always credit that revenue account. At the stage that you're in now, you're gonna always credit that revenue account. Your expense accounts, you're gonna always do what with them? Debit. You're gonna always debit them at this stage. As you get further down in accounting advance, if you're going in that field, you make some corrections, some adjustment down the road a bit. But as of now, you're going to always debit those expenses to increase it, and you're going to always credit those revenue accounts to increase it. So looking at that first one, what's taking place there in that first one? Issue common stock for $100,000 cash. She said, we're going to debit cash, you're going to debit cash, and you're going to credit common stock. Can you guys see that? Trying to hide the other one. Not doing a very good job. But you're going to credit common stock. So there's your debit and your credit. What else has to be in that when you're doing those debits and credit journal entries? We know we have to have a debit. We know we have to have the credit. What else has to happen? They have to balance. They have to equal. So you can't have a debit of 100,000 and then have a credit of 90. It's not balanced. It won't balance. And then what happens to that effect is, if your journal entry don't balance, guess what won't balance either? The balance sheet won't balance. Absolutely, it won't balance, because everything that comes through these journals is going to flow over to those statements. Is going to end up in your balance sheet. So the next one is number 2 says purchase $500 of supplies on credit. So you bought supplies on credit, and someone asked me about on credit. So in this case, what we got? Debit supplies and credit accounts payable for $500. Absolutely. Now supplies, and we talked about this earlier too, as far as asset. What type of account supplies would be? It'll be a current asset. Sure will. It'll be a current asset. Supplies will be a current asset. Let's go to the next one. And I know you see equipment up there, but this one has about 3 accounts involved with it instead of 2. It says purchase equipment for $25,000, paying $3,500 in cash, and then you signed a note for the rest of it. So how many accounts we got going on? We got 3. Who can name them for me? Equipment, cash, and notes payable. So we're going to debit equipment for the total amount, because that's the value. That's what it costs. So we're going to debit it for the total amount, and then we're going to credit cash for what we paid, which was the $3,500. And then the rest of it, we signed a note and said we're going to pay it later. And that's the notes payable. The next transaction is 4. It says paid $250 cash, and this is the thing here, on account for office supplies purchased in transaction 2. So a lot of times you got to look at what you've done. You created an accounts payable here of $500 because we purchased some supplies on credit. Now we're going back and we got to pay that down. So when that's the case, we got accounts payable that we have to reduce $250. Because we're paying on the account. So we know if we increase that liability with a credit, in order to decrease it, we got to debit it. to decrease it. So you'll see a debit to accounts payable for $250 and a credit to the cash for $250 because you're going to reduce your cash as you're paying it down. Let's go to number 5, and this could be a little tricky. Number 5 says prepaid rent for $9,900 for the months of August, September, and October. So what this saying is we prepaid the rent ahead of time. Boom, we paid it off for 3 months up front. How many of y'all do that? We prepaid it 3 months ahead of time, right? So in that case, anytime you prepay something, you debit it and it becomes a what type of an account? It becomes an asset. Anytime you prepay something, it becomes an asset. You would think that it would be rent expense, but not when you prepay it. When you prepaid it, it's going to be a prepaid rent, but it's going to be an asset first. So, and we're going to talk some more about that. So we're going to debit prepaid rent for $9,900 as an asset. And it's going to be a current asset too, team. It's going to be a current asset. And we're going to credit the cash for $9,900 for the amount we paid. Now, as you get further along in your chapters, probably you'll hit chapter 4, it's going to explain to you what we do to that prepaid rent. Because we don't leave it there. You're going to reduce it later on. You're going to reduce it as you start to live in the place that you're renting, and it then converts to an expense. A rent expense. But you can't convert it until you use it. So as long as you haven't used it, it's an asset and it's prepaid. And you'll see that later on in your chapter 4 where it shows you how to convert that. So right now it's going to be a prepaid rent, $9,900, of course, the cash. The next transaction is number 6, and it says we paid $2,500 for salaries in the current period. Simple enough. You paid salaries for your employees. You paid it. So that becomes your expense. So we're going to debit salaries and wages expense for $2,500, and we got to reduce cash because it says we paid cash. It didn't say on account. We paid cash. So we're going to reduce the cash by $2,500. Notice every transaction we're doing, it's a debit, it's a credit, and it balances. It has to be the same amount. Number 7 transaction. It says, I'm going to fly back up here and I know you all have a handout, but let's go back up here and look at number 7. Number 7 says, perform services and collected $1,200 cash from customers. What's going on there? What tells you in this transaction that is service revenue? Perform services. Now notice, it doesn't become a revenue until you perform it. So if someone gave you cash and you didn't perform it, it's not a revenue. And we'll see that later on in the last transaction. If you don't do it, it's not a revenue. Yes. When you receive money and you have not done the job, you can't record it as revenue. What happens is you record it as unearned revenue, and unearned revenue is a liability account. That's what it is. Because until you do what you say you're gonna do, you gotta give them their money back. So that's why it's a liability account. It's just like FSU. If they sold some ticket ahead of time, they'll put it in the unearned ticket revenue until they play the game. Then once they play the game, then they'll go ahead and convert it to ticket revenue. Unearned revenue is a liability. Sure is. And that's exactly where I was going. She beat me to it. It's a liability. So in that transaction, let's go down and see the recordings. And I know you told me what it was, number 7. We got cash for $1,200 and service revenue for $1,200. What about number 8? Number 8 says perform services, but it reads and bill customers $750 on account. Perform services and you bill. You're looking like, what are you doing there? And you billed customers for the $700. What happened? You would debit accounts receivable. Exactly. Because what took place is you did the work, and that's why you recorded it as revenue, because you did the work, but they had not paid you yet, which means you gave them an invoice for a bill and said, I know you haven't paid me now, but here's a bill. I want you to pay me later. So that's why they say bill the customer. So when you bill the customer for your services, you're going to debit accounts receivable. And accounts receivable is what type of an account? It's an asset. So you're going to debit that accounts receivable, and you're going to wait on them to pay your money. You're going to wait on them to pay your money. So that's what that receivable is sitting up there at. So number 9, let's go to number 9. Number 9 says you collected $750, and let's go back up here and see that again. I know we're moving around, but you collected you collected $750 from the customers on account. And what they're talking about is this transaction here that you got on account. So now you came down here and you collected the money from those customers. So what am I going to debit and what I'm going to credit? You're going to debit cash and you're going to credit accounts receivable, because you got to reduce that accounts receivable. So because they don't owe you anymore. You're going to reduce that accounts receivable because they don't owe you that $750 anymore. Yes, it'll tell you. It'll tell you. Let's go back up here and let's read that again. That's a good question. Let's go back up. You say, how do I know that it's cash? And this is what happens. If they say collected, if they collected something, it's usually got to be money. Usually got to be money. They'll either say collected or they'll say paid. And that's how you know that it's cash. It'll say paid or collected. If it don't have, and I know it's got on account, but this on account in here was referring you back up here. Yeah, if they say received, that's going to mean they got cash. You don't seem like I cleared that up. Let's go over that again, because it says collected this money right here. And that's the only thing you're going to be collecting. You're not going to collect anything else but the money. And they usually go collected or they go paid or something like that. Let's go to number 10, and it says you borrowed $15,000 cash from a local bank, and guess what else they did? They say what? Payable in what? Accounts payable. But if it's in 3 years, what that means? And let's go down there and see that transaction. I know we're going down here to the journal entry. It's going to be a note. You see that note? Because we went to a bank and we borrowed money. Went to a bank and we borrowed money. And 9 times out of 10, when you go to a bank and you borrow money, what you going to do? You're going to pay it back, but you're going to sign. You're going to sign for it. Well, the payable in 2 years, but you go into a bank and they're not going to let you have anything out of there unless you sign a note. That's it. That's the deal. You can if it was an individual, you could have said, yeah, they just gave me the money. But if it's a bank, you're going to sign. You're going to sign something. You're going to sign a note. Generally, it would say it though. Generally, it would say it. But in this case, the emphasis was on bank. It was on bank. So you got cash of the $15,000 the bank gave you. You got a notes payable that you signed that you're going to pay the $15,000 back. And then the last one, which I'm showing you already, and we talked about it already, was the unearned revenue. And that transaction said, and I'll read it off to you, and we talked about that. I kind of jumped ahead on that. It says, on the last day of the month, received an advance in services to be performed during the following months. But however, I think we got the wrong amount here. Let me make sure I got that right here, but we can correct that. It said received $1,300. So you got $1,300 in advance. And I'm gonna go down here and change this, guys. Take a 0 off. You got $1,300 in advance, and what we said about doing something, doing work and you get paid in advance is unearned revenue. Can't be revenue unless you've done it. And we said unearned revenue was what kind of account? It's a liability account. So every time you receive income, what's considered to be income in advance, and you haven't performed the work, it's going to always be unearned revenue before you've done it. Now, later on in chapter 4, it's going to show you how to reduce that, because we can't leave it there, because you're going to soon do the work, and we're going to have to reduce that unearned revenue, which we're going to end up debiting unearned revenue and then crediting revenue for the work that's done. Make sure you know the debits and credits. Make sure you know it's a double entry accounting. Make sure you know you got to have the debits got a balance. Make sure that. Make sure you know the flow of the statements. Make sure you know what's an asset, what's a liability. Also, as an asset, let me ask this question to help you out too. As an asset, what's the normal balance of an asset? Because they could say something about normal balance. This is the key. Whatever side you increase the account on, that's what a balance should be. So if it's an asset and I increase the asset with a debit, my normal balance should be a debit. So if I increase an account and you notice it and I increase it with a debit and you notice it has a credit, something is wrong. That's not the normal balance. So whatever side you increase it on, that's what the normal balance should be on. So remember that. And that's all I got, folks. Hopefully you got some more questions. If you do, just come by the Learning Commons and we can answer it before it's over with, before your test, hopefully.